So to start with, let's actually talk a brief moment about the cyclicality of the markets and seasonality. Okay, so what it means. Let's get it started from the very beginning. Okay, so some of you may or may not know that my main background, is chemical engineering, is a chemical technology engineering. Got master's in that in 2017, and this taught me to kind of like perceive the world in the question of matter. Okay, not even the particles, not even the chemical bonds reactions and so on, but having like this kind of like deeper look into what is surrounding, okay, what is going on around us. So if you apply physics and trying to understand, from the physical point of view, uh, how it happens and how it applies actually in the financial markets, you can come up with some several very intriguing and interesting conclusions. Okay, so to start with, I want to give you a quick kind of like an explanation. We as people, being part of a nature around us, we consist of matter. Okay, and this matter is countable. Okay, it is corpuscular. I hope that there's such a word for that, but we have countable particles, okay, that build us, some chemical elements, okay, and those particles, those elements, they do consist of some smaller elements, okay. So the atoms consist of subatomic, just fractions, be the protons and neutrons, okay, and so around it there are many different chemical models, but there is some layer, filled with some electrons, okay, which are oscillating around this somehow, okay. That is some, let's say, simplified version, okay. But knowing that we consist of those particles, and these particles, like protons, neutrons, they even consist of smaller particles, which are called quarks, okay. These quarks also consist of even lower grade, smaller matter particles, although they are not discovered just yet. Then it's kind of like endless loop. You just go deeper and deeper and deeper and deeper, and you're actually never going to catch this white rabbit, if you know what I mean. Okay, but the most important part of this all is that each and every single particle of this atom, okay, of matter that creates us, it does move. It is dynamic. It is not static. It does move. It does live, and it does move in oscillations. So each and every single part of us, as the material bodies, oscillates and vibrates. So if each and every single part of us oscillates, then we as people oscillate as well, right? You have a day and night cycle, you have a life and death cycle, okay? You have seasons, you have many different other cycles that probably are going on in your body, and we as people create the market. The market is this physical or virtual space, if you will, okay, where buyers and sellers meet to actually transact with each other. Dark matter as well, of course, yes. So we as people create the market. So if we as people oscillate, then if we build this market, then the markets oscillate as well. Right? The markets do oscillate. The markets do vibrate. Just like there is this anecdote from the early days of technical analysis. They say that one of the inspirations for behind Elliott waves theory, that is kind of like, again, implies the waves, in the markets. It kind of like assumes the markets moves like waves in the ocean, okay? So you can tell that there is a day and night cycle. And for example, during the day, that the waves, reach only a certain distance into the sand, right, into the beach. But for example, because of the change of, from like the sun and moon, the daily cycle, it tends to differ, right? So during the night, you would have different kind of like penetration distance, if you know what I mean, right? So you have periods where this ocean, where this water actually reaches further into the beach, right? Or it goes kind of like not so far. And this led those early analysts, those technical analysts, understand that markets and then the trends move like. But that is what helped those people develop a theory about the markets, okay, that we move as waves, as the market. So knowing that, again, we have some sort of cyclicality phenomena going on. Before I pull up some charts, I definitely want to make sure that you understand that there are some paradigms, okay, that there are some facts or main assumptions, some paradigms upon which the entire theories are built. Okay, so knowing about the seasonality, let me actually just get you to the file that I prepared the other day. Okay, very quick. Let's have a very quick hop and look into this. Okay, I hope you should be able to see my screen. So this is a file. This is a file, guys, that I prepared for my private mentoring students, for my coachees. Okay, I believe it was 2019. Okay, and this is a chart. This is a Bitcoin's chart, or actually BLX, the Bitcoin's liquidity index. Okay, it was before even 2020 started, where Bitcoin was approximately around those $7,100. Okay, so you have this chart. Okay, it doesn't matter if it's actually not up to date or not, but what matters is that you can see the cyclicality going on. Okay, you can see those cycles. Okay, those waves up and those waves down. Okay, those bull markets sides of the cycles, and the bear market sides of that, right? Bull markets and the bear markets, and they all move. These moves kind of like come subsequently, okay, in oscillations. And if you will, by the proper definition, from the physical point of view, from the chemical point of view, what defines a cycle at full oscillation, if it happens, let's say here is some amplitude, okay, some distance, or this can be a price, let's say extension, some percentage of the movement. Okay, and here's the time factor. So if it moves over the time, if it progresses over the time, then in general, the cycle, the full cycle, is the, let's call it quote unquote distance, this measure on the horizontal scale, okay, on the time scale, separating two exactly same or similar phenomena, right? So you would have the market peak in here, you would have the market peak in here. So the time cycle is this distance between this, okay? In the distance, I mean in the measured in the time unit. So that is the cycle, okay? Or measured from the bottom to bottom. So you know that the full cycle starts, as a matter of fact, with accumulation, and the cycle ends with the accumulation. We have this full oscillation. That's where it starts, goes to the extreme, right, and goes back, and that is where it starts another cycle. So you can have the sine curves, if you will, okay? But it doesn't matter too much if it's going in a channel, or if it's actually emerging, just like you can tell for Bitcoin. Okay, it keeps proceeding higher and higher. Each and every single market cycle high peak is higher than the previous one. Okay, this is, by the way, you can tell there was my early call about Bitcoins literally being this early, right, where I called this stage of $7,000 at the market, being the retest of a major breakout. Okay, so actually that is a chart that many people would probably call legendary, if you will. But yeah, that was way before Bitcoin actually reached all the 65,000s. So this is to prove to you that we are moving into cycles, and we have also some different measures of those cycles, right? You have Kondratiev waves, for example, which last about 50-70 years, and they are not even fully reported to be confirmed, right? Although there are many pros and cons, pros and against, for that. As I was saying, you have many different measures of the cycles. You have big cycles, you have some small cycles, daily cycles, as I said. You have presidential cycles, which last 4 years, okay, 4 years. And also within one single year, you have, many different seasons, right? Most often, of course. So you would have the seasonality effect, right? The seasonality effect is something that corresponds with the fact of seasons existing, seasons in the market. So you can tell some repetitive phenomena going on within different seasons of the year. And that way, you can tell that, for example, quarterly look, you have quarter one, you have quarter two, okay, you have quarter three, okay, you have quarter four. For Bitcoin historically, you can tell that the biggest, the greatest deal of the all reversals, so the major reversals like this, Okay, this is the start of a new year. Like this one, this is the start of a new year. Okay, of this one, this is the start of a new year. You can tell that all of these reversals practically happened within the same season, right? Somewhere around the end of Q4. Most major reversals in Bitcoin's history for the major impact happened and occurred at the late Q4 stage. So that is what we call the seasonality. What we call the seasonality is always also the fact that Q3 is usually the laziest of them all, right? So you can tell and expect Q3 most usually to be of corrective movements, usually sideways, right? And you can tell that because, well, usually this is the vacations time, right? And if this is the vacations time, then you can expect people, I'll be right back with the chart. You can expect people to actually just go on the vacations, just chill, not get too much interest in the markets. How it actually comes, and as a result to the markets is that you see way lower engagement from the traders. You see way lower volumes, okay? You see way lower, open interest as well. The overall less engagement, less interest in trading at that time. So now let's say that the world is waking up from the, and somehow recovering from the lockdowns. This may somehow imply and help us project and understand that perhaps, maybe, just maybe, of course, this is some percentage probability game, that if those people, had been locked down, for like in homes, right? Not going anywhere, then just maybe, there is going to be some spike in the sudden, just last minute trips, right? Or intensified activity on like to go to the vacations, right? Perhaps some well-deserved rests needed, right? So just maybe you could assume somehow or imply that there's going to be even lower interest and lower engagement in Q3, okay, when compared to the previous years on average, knowing that in the past years perhaps we didn't have lockdowns and now we had the lockdowns, right? So people want perhaps even more to actually compensate for that, right? And just go and chill even more. So that is somehow what helps you perhaps decide that the Q3 this time is going to be even lazier than the past month. So perhaps no fireworks are coming. Usually when the markets are within or without any interest, the market stays stagnant. It does not trend, because it lacks power, it lacks dynamics in either direction, right? How can bull market, let's say, resume within 10x pumps for 10x pumps when there is nobody to buy that because everybody's chilling and getting drunk on a beach, right? You know what I mean? So that is what defines the seasonality as well. So they say that how the January opens as well in Q1, that's the way that the entire year goes. They say there is also this popular saying in Q2 that sell in May and go away. Well, that is popular. That came from the stocks industry and not and beyond. Okay, it's no crypto, but well, have a look. We topped out at $65,000 at least locally. I'm not claiming this is the top. I'm actually claiming otherwise. But locally we peaked. So technically, practically, if you follow the seasonality suggestions, then you walked away, sold in May and walked away, right, in quite a good bunch of profit. So this is the seasonality effect. On top of that, let me just very quick introduce to you this website of ours, of course, the Birb Nest, okay, and we have tons, insane amount of free resources, newsletter, webinars, of course, just like this one, podcasts, not to mention my blog, when I post on a regular basis, this is an actual article, right? But when you can see, read insane amount of articles, my personal trading reports, okay? So this is all free, but if you go to the infographics, then there is this seasonality effect kind of like displayed in one of our cheat sheets, okay? Let me just find it. And that's how we called it actually altcoin hype cycles. So Bitcoin, just like overall, all global markets are correlated. All global markets are correlated. Bitcoin is correlated to what gold does, Gold is correlated mainly to what dollar does, and so on and so forth. It's like one network, right? It's one big network, unless there are barriers and some embargoes or some difficulties at the borders, not allowing, from the regulatory point of view to trade. Then unless that exists, you have kind of like a freedom. You are supposed to have some form of a free market. Okay, the capital fluctuates and moves. Okay, it never stays in the same place for too long, because when it stays for too long, then the market gets overheat, right? The market is really getting the proper overheat, and you have the market which is overbought. If everybody buys, then you can only sell, right? So what's the point of holding and giving away all the entire money, then profit that you made? So knowing of that, again, you can know that there are certain seasons, certain times of a year or years where some assets perform better than the others. Like, for example, just right now, there might be amazing time for commodities. Now, of course, locally, because of dollar actually, started heating up a bit, but there has been, this is a monthly chart for the commodity index, just to give you a scope. Okay, so this is a 50-month moving average. Okay, 50-month average, and this tells you, this is actually a volume-weighted average price. Okay, so you can tell there's been some golden cross going on the monthly chart. So this time, this actual breakout that occurred in February this year, this very first breakout that occurred in February hadn't happened before it did ever since 2013, or should I say 2012 even. This was the last actual upside breakout, okay, until now. So you are talking about unprecedented event. The first time in matter of 8, okay, or 9 years, we saw a massive upside breakout on the commodities from the technical point of view. So like, this is some legendary bull market signal, right? So first time in years, it actually broke to the upside. This is something that you cannot ignore. Okay, so knowing that, it somehow, defines the monetary policy for Fed, and what they do with dollar, they stimulate the commodity markets as well this way, right? Perhaps my theory is that the gold was actually getting too expensive, and gold being the most strategic and the most essential, important asset upon which the entire countries are built, for the monetary policy safety. It's confirmed that the central banks have been accumulating in the past decades gold like crazy, okay? Because if things go down and things go south, if people lose faith and belief in the currency, this is where hyperinflation starts and the countries may go bankrupt, okay? So it's very important to have gold in store. And it's in countries and states' favor to keep gold prices rates low. And gold's apparently was doing too well past months. So they promised, or they announced, this was a news play. Fed announced on the press conference that they're going to potentially make first steps towards hiking the interest rates in 2023, which is, in my opinion, just only the FUD, because with this amount of money ever printed, which is 23, I believe, no, sorry, approximately 27 to 30% of ever printed money was printed in 2020. So all the money that was printed in decades or in centuries, so we printed about 30% of that total number just in the past year. That is what definitely just brings the potential of insanely big inflation. Okay, the only element lacking is somehow the accelerated spending. Okay, so one way or another, the gold prices, the countries hate expensive commodities because it's kind of like it's the commodity prices. When there is a country rich in commodities and the commodity prices rise, then it may actually just destroy your export if that is your main source of income from the economic point of view, right? So this is some serious stuff. So there is a season where commodities are going to do better, okay, than not. For example, back to the seasonality infographic, you can tell that similarly, altcoins and Bitcoin, they do have some better performing months and seasons. So you can tell that usually on average, the quarter 1, okay, starts with some serious dips. Okay, the quarter 2, comes with usual solid dips opportunities as well. Okay, so right now we are in quarter 3. Of course, this is some average situation. So don't apply that literally, that if it must bottom out for every altcoin in 15th of, or not even 15th of, or like middle of May, otherwise it's not going to, it's wrong, right? This is just some average picture. But the altcoins, they intercorrelate with Bitcoin, and Bitcoin intercorrelates with gold and dollar, just like I said. So there is a cyclicality in the seasonality in a way that whenever altcoins, as the entire market cap, let's say you have here the market cap of altcoins, you can tell this is, I believe, 200-day average. Okay, this is a daily chart. So we can tell that altcoins as the industry, as an entire group of assets, okay, declined ever since May 15th by, well, top to the bottom, on average by 52% on average. Okay, if you apply some extreme values, not just the daily settlements, let's say, you have almost 60%. Okay, so that is some large numbers. So you can tell that this is definitely some dip, and the last dip of this kind, apparently from the nominal point of view, never happened before because we are large as a market. But from the percentage point of view, it probably happened before, let's say, where the COVID crash, right? You can compare that. So there was very similar volatility. There was similar downside volatility for altcoins. And that historically shows you that the best reversals in the market come after severe discounts, okay? After each and every single massive downside part of the cycle, okay, you can expect this to somehow bounce anytime. So, and on average, you can tell that there is 50 to 60%, at least in this bull run, discounts. So this gives you a scope, for example, for what to expect for altcoins in the next months, in Q3 perhaps. You can also tell that there is a correlation with between Bitcoin and altcoins, right? So whenever Bitcoin is the king, whenever Bitcoin outperforms altcoins, it's safer. This is shown in the dominance chart. Okay, the dominance chart it's not the dominance chart that defines this, but the dominance chart is a result. Okay, you cannot trade the dominance futures. So this, as it doesn't work as a self-fulfilling prophecy, it's not having causation. So I think there's it's kind of like pointless to bring this entire superposition effect one more time to this, because I explained it so many times already. If you guys want, there was a video on YouTube that I actually did about that. And I do believe it was there. I do believe it was explained somehow, either on my last Friday's webinar, which is this one, or the one before. Okay, so the superposition effect is something that defines the profitability of altcoins and its correlations with Bitcoin. So make sure, guys, you actually scroll through the videos, because there is so much insane content. That is the fact. Okay, so we have to, as the tip number one, accept the seasonality, accept and take it as something that is granted. Okay, the cyclicality and the seasonality exists. Okay, that is something for you to understand.